Welcome back to Finance in Focus. I'm Brady Hansman. Now let's talk about what's going on in the markets right now. Because if you've been watching the headline, it probably feels a little chaotic. And honestly, that's because it is. But today I want to cut through the noise and focus on what actually matters. We've had a very strong run in the markets, no question about it. Stocks have performed very well, and a lot of portfolios have benefited from that. But now we're starting to see something different: volatility and consolidation. You're seeing big names like Meta and Nvidia pull back even after strong performances. Now that confuses a lot of people. How can a company beat expectations and simply go down? Simple. Expectations were already high. When stocks run up too far, too fast, even good news isn't enough. This is where most investors get into trouble. There's a growing disconnect between what companies are actually earning and what their stock prices are suggesting they're worth, and that gap. It doesn't stay forever. At some point, reality catches up. That doesn't mean everything crashes tomorrow, but it does mean risk is higher than people want to admit. Now let's zoom out, because this is where things get more serious. We're seeing inflation ticking back up, interest rates staying elevated, oil prices rising, and borrowing costs getting more expensive. Even mortgage rates are still nearing multi-year highs. That matters, because when the average consumer is spending more on essentials like gas and debt payments, they have less money to spend elsewhere, and that slows down the economy. Here's what doesn't make sense right now. We're seeing weaker economic data, but the market is still pushing higher. Why? Because a lot of money is still chasing growth, especially in areas like AI. And look, AI is real, it's important, it's not going anywhere. But that doesn't mean every company tied to it deserves sky-high valuations. That's where people get burned. Here's the part most people ignore. When stocks get overextended, the upside might be another 5 to 10%, but the downside, that can be 20 to 30%, sometimes even more. And when those corrections happen, they don't feel slow and controlled. They feel fast, they feel emotional, and they force bad decisions. So what should you take away from all of this? Not panic, not try to time the market, but understand this. We are in an environment where discipline matters more than ever. That means knowing what you own, understanding the risk, and not chasing hype just because something is going up. Because eventually, fundamentals always matter again. At the end of the day, markets don't move in a straight line, they go through cycles. Right now, we're seeing signs of stress beneath the surface, even if the headlines don't fully reflect it yet. So stay patient, stay disciplined, and most importantly, stay informed. Thanks for watching another Finance in Focus. We'll see you in the next one.